Hey guys, Nels Larson, CPA with Guidance Accounting. Just wanted to chat with you for a couple minutes about cost segregation studies. Cost segregation studies are something that, pretty much all real estate investors should at least be aware of, whether it's something you think you would ever utilize in your own investing, buying and selling activities. So effectively what a cost segregation study is, when you buy a piece of property, typically there are two components. You have land that the property sits on and is part of the deed typically, and you have a building. And then you're going to have contents within the building, kind of subcomponents. Buildings, if it's residential, so whether it's single family home or multifamily property, get depreciated over 27 and a half years. It's a long time, right? If it's a commercial property, so office, building, warehouse, strip mall, anything like that, the building actually gets depreciated over 39 years. So that's an even longer time, obviously. What cost segregation studies do is they look at the purchase price and how much, particularly if the cost segregation study is being done maybe a few years after the investor actually bought the property. The cost segregation study is looking at the total purchase price, how it was allocated between land and the building, and then within the building, a cost segregation study will break out the value of plumbing system, HVAC system, electrical system, and then if there's any other personal property, as well as land improvements, parking lots, landscaping, stuff like that. Parking lots, landscaping, stuff like that often can be depreciated over 15 years. So whether you're talking about residential real estate where the buildings depreciate over 27 and a half years, or commercial real estate where the buildings depreciate over 39 years, if you can carve out these subcomponents from the building and get them into a 15-year asset life, like a parking lot or land improvements, landscaping, then obviously we can get more depreciation in the earlier years that we own that asset. So it's a time value money play effectively is what we're doing. We're trying to get more depreciation into the earlier years of the asset instead of having to spread it out over that full 27 and a half year or 39-year life that the IRS requires. And then obviously the more value that we can allocate to the building and the contents of the building, away from or out of land, the better, because land never gets depreciated. So if you've got a building, $500,000 building that you buy a building for $500,000, and for whatever reason, maybe the person who prepared the tax return, or maybe there was an appraisal done, although not always, if we've got allocated half that $500,000 purchase price to the land and half that to the building, well, that $250,000, we're never going to get a tax benefit from that, at least not while we own the asset, because we can't depreciate the $250,000 of land. The $250,000 has been allocated to the building, again, commercial, residential, if it's residential, 27 and a half years, commercial, 39 years, we'll get benefit from that. But if we can, maybe instead of 50-50 on the land versus the building, if we can allocate more of the purchase price, say 65 or 70% to the value of the building away from the value of the land, that's going to provide us more benefit. Typically what a lot of CPAs do is when they're working with a client who has just bought a piece of real estate, they'll ask for a property tax statement, or they'll ask for a CRV, certificate of real estate value. And oftentimes then the CPA can get a sense of what the value of the land versus the value of the building is in relation to the total purchase price. So that's obviously a good way to do it. I've had clients where literally they had an accountant or CPA, somebody who predated me, working with the client, who allocated even more than half of the purchase price. In this case, it was a strip mall I'm thinking of, and it was like a $3.5 million asset. And they'd allocated, $1.8, $1.9 million to the value of the land, and then the remaining, 1.6, 1.7 to the value of the building. And they didn't break out components at all. So we had a cost segregation study done on that. And the cost segregation study in that case, I think we paid about $10,000 for the study, but we were able to amend, we amended the client's tax return for the prior year, and I think we got $110,000 back. Just, again, it's a time value money thing because we were able to get more depreciation on the front end, and the client had probably owned the building for about 2.5 years at this point in time. And with a cost segregation study, you can do kind of a catch up. So if in this case where the client had owned this real estate for a couple of years, they were able to get credit for what they should have gotten for depreciation, the prior couple of tax returns that were filed. When we filed their most recent return and amended it, we were able to do a makeup adjustment called a 481A adjustment with their tax return. And so, it worked out really well. The client was really happy. If you could spend 10 grand and get 110 grand back within a matter of a couple months, you do that all day, every day, right? So hopefully this has been helpful. I'm going to wind this down and we'll be in touch. Take care.